Let me show you an option trading strategy I use on Spirit stock and many others like it. This is the chart for Spirit Airlines for the last 7 months. It has traded in between $20 and $28 for that time span. Not a ton of movement from this chart, as this is a less volatile stock. It typically trades in a certain price zone unless some big news comes out. As such, every month I use a strategy called a calendar spread on Spirit, as well as other stocks with similar patterns. This is how a calendar spread would look, and these prices are actual prices pulled from Spirit's pricing chart. With this trade, you will want the stock to typically be in the middle of this pyramid the closer your trade gets to its expiration date. However, as you can see, you have some wiggle room for it to move around and still make profits. The theta is how much value this trade earns every day, and that number grows larger the closer the trade gets to its expiration date. The closer the stock gets to those pyramid edges, the less money you make, and it eventually runs into the point in which you would just break even and make what you paid back. Let's look at a larger example. Here's another real world example of where you would have paid more to enter into this trade, however, the possible profits are higher. You'll also notice that the theta is higher to begin with, and that number will grow larger the closer this trade gets to the expiration date, as long as the stock is still trading within the profit zone of this pyramid. The closer it gets to the break even, the less you make. However, as long as it stays in between 16 and 24, you will at least break even. One question I receive a lot is what can I do if the stock starts to leave the zone of the pyramid? You have a few options. One of them is to close out the trade, and if you have closed it out early enough in the cycle, you will most likely have not lost much money compared to what you paid if it's early on in the trade. You can see in this example here of a calendar where the break evens are a little above 18 and a little below 22. It is showing that if the stock moved up to $23 early enough in the trade, you would only be down $19.99, and you could cut your losses and exit the trade. Another option is to create a double calendar. Now you have two profit zones. You have to be careful with this trade as the price paid has to make sense, as you do not want to just keep opening new calendars. When one of the calendars or pyramids is profiting, the other calendar or pyramid is losing. So you have to make sure that the possible profits make sense. If the price paid versus the possible profit is good, it may be worth it in the end. Now we have an extremely wide field to make money. The longer you hold a calendar, the more value it will have. You do want to, however, try to close this out at least a week or two before the expiration date. It is a low risk trade as you would only lose what you paid, and often with calendars, you can close a trade out before losing all of your money happens. You would only do this trade on low volatility stocks. The idea is for the stock to not move around much, and the sweet spot is right in the middle. Some of the negatives would be it takes a while for the profits to accumulate. Many traders are impatient and not willing to wait the 30 to 40 days for this trade to gain value. You want to avoid this trade when a stock has upcoming earnings. Earnings bring volatility, and remember the last thing you want with this trade is volatility and the possibility that this stock will rise or fall significantly. Lastly, max profit is often not the goal. If your possible max profit is $1,000, I typically tell clients to close a trade out when they have realized 25 to 50% of that max profit number. You don't want to have profits and suddenly lose them because the stock shifted significantly. Hopefully, this helps you in your trading portfolio.